Okay, we're at number 10 now. And when we left last time, we mentioned that value creation, which we're abbreviating as VC, really is a wealth increase, or you can think of a price of a stock, if you will. It's over and above the expected increase, which is the cost of earning just the cost of capital, or NPV equals 0. Okay, and the reason the expected NPV is 0 is because you're in a capital market and supposedly everything's been expected. So whatever is expected, if you can beat it, then you get a value increase. So that's the definition, not just the fact you're making money. In fact, this leads to an interesting little conundrum, if you will. Let's suppose in the first period you invested in your products and you determined the net present value is equal to 5, say. The next period 6, next period 5, etc. You've been doing real well. Now suppose that your net present value that is calculated or anticipated by the market is going to be 2. Now what happens? You're still beating the cost of capital. You're still creating value in a sense, but your stock price will go down. And this is sort of the mathematical way or shareholder value way of saying, you know, what have you done for me lately? And in fact, one of the reasons you hire management is to beat the cost of capital. But if you've been beating it, and then you don't beat it as much as the market anticipates, then your stock will drop. And this happens all the time. So it's not an easy world out there. Okay, so we again say that a value creating strategy expects us to earn more than the cost of capital, and that's called positive value creation. And for a publicly traded firm, this is only possible if the market players fail to anticipate the results. And actually, this is interesting. This is one reason that inside info is illegal. And in almost all cultures, this inside information is illegal. So, okay, so now that we've sort of beat that to death a little bit, but if we're looking at the mechanics of how do you do it, I'm going to get into how you really do this when you're dealing with a company. And if you look at, I like to draw this diagram, shareholder value, and it's got 3 pieces to it. And okay, the first piece, of course, is risk. One of the next pieces here is cash flow. And then the third one is long-term expectations. And if you really think about it, in most cases, you're investing, say, 50 cents on the incremental dollars, about an average for the S&P 500 companies, and your profits are something like 10 cents, maybe 5. So in almost every case, you have a pretty big downstroke before you have any kind of upstroke. So if you don't have long-term expectations, you're not going to create any value at all. And I think you remember from a previous video that this is the reason that taking care of the shareholders is consistent with taking care of all the other stakeholders that are involved in your business, both internally and externally. So how do you do this sort of thing? Now, when we look at risk, we capture risk with the cost of capital. And remember, again, management has to deal with the total risk of the firm, but the diversified players, the market players, are only going to pay you for the risk they can't get rid of. So they can get rid of all the unique risk that's peculiar to your firm. So they're only going to pay you, if you want to look at it that way, for the risk that pertains to the whole market as how your company relates to your portfolio. And that's how the professionals look at it, and unfortunately that's the way things are priced. So if you take some crazy risk, you won't get necessarily paid for it. You will not get paid for it in the sense that your stock price will go up. The cash flows, we capture those with a model of expectations, and we then say that value, of course, it's the sum of these expected cash flows. I'll write that a lot, but almost all the time when we're talking the future, when we say cash flows, we say expected, and it's net of investment. So, and we take the sum of those and we divide it by the 1 plus the cost of capital to whatever period you're talking about, and equals 1 to actually forever. The firms essentially live forever. But remember, we broke this into a forecast period and then a thing called the residual value period. Okay, now how do you get these cash flows? You get these by a thing we usually call value drivers. And that's fine, but you also, almost every case, have sub-value drivers. And that's really the art of modeling. The art of modeling is to make sure that you have the proper sub-value drivers that management has some impact on. And really, one of the ways I always do it working with a firm is just say, okay, what does management influence? Now, if you're a bank, for example, interest rates are absolutely critical, but really management doesn't have much to say about that. You're pretty much governed by what's out there in the marketplace. So it's a strategic variable, but unfortunately it isn't one you have a lot of control of. So look for the ones where you have control, and then you can start building your models around those things that management has influence. Now, the other thing to remember is here from the long term. The long term is almost always more important than the short term. And you know, that's fine. And part of the reason of that is that firms live a long time. And frankly, in most investments, you have no idea if you're creating value or not until you many years. And there's lots of evidence for this. But, when I say but, let me just change the color here. You have to worry about liquidity now. Remember, I said that when you look at a company, and let me draw it here. It's a bad balance sheet here I'm drawing. But anyway, the assets over here, that's where management spends its time worrying about this. And you historically have almost always assumed you could finance anything. It's just a question of cost. Well, unfortunately, not anymore. This now may be a major constraint. And if you're a financial institution, well, even if you're not, there are some sort of implied rules in banks. Regulators talk about this a lot, but this would be your liabilities here, sorry. And they look at ratios of equity, debt to equity ratios or equity to asset ratios, and these ratios have to be maintained. And we'll talk a little bit more about them, but it might turn out that part of the reason you can't get anything financed is because folks just don't believe that you have enough wherewithal to withstand a downside. So that's another thing that you're going to see lots of. What you want to look at downside, oh boy, simulations. Again, running out of time, but we'll carry this on for the next lecture and push it a little further.